Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, the economics of Bernie Sanders, former chief economist during the Sanders presidential campaign, Stephanie Kelton, over from New York, to tell us why we should not worry at all about racking up government debt. The Great Divergence. Scott Bessent, CEO of Key Square Group, talks markets and trade wars at the sidelines of the Sohn Hearts and Minds conference. And the young Australians over in San Francisco are bringing Australian venture capital money to American startups. We meet Darling Ventures' Daniel Darling and Kindy founder Ryan Welsh. Well, just a quick update on Brexit. And my goodness, Theresa May is in the bunker, isn't she? Overnight, she lost the Brexit Secretary, Dominic Raab, who yesterday, the papers, and I was saying the same thing, had her supporting the Brexit deal. She's actually lost 4 ministers in total, and Jacob Rees-Mogg, the chairman of the Brexiteer European Research Group, the ERG, has sent off a letter of no confidence in the Prime Minister to the famous 1922 committee of Tory backbenchers. Now, their problem with it all is, with the deal, is that Brussels will in fact be Brino, Brexit in name only. Or actually worse, it would leave Britain as a vassal state as part of the customs union in perpetuity, but with no input into European trade policy. They have issues both with the fact that Brussels will have a say in whether Britain can finally decide to move out of the transition period at the end of 2020, and that there will be a difference in the type of trading regime between Britain and Northern Ireland with the rest of Europe. And so that might put a line through the Irish Sea. And the DUP and many people in Britain see that as threatening the Irish peace agreement, which of course is a no-no. For her part, Theresa May, who took a pummelling in Prime Minister's question time yesterday, is vowing to fight on. Well, coming up, we'll have David McCready in from the Australian British Chamber of Commerce to unpack the latest. Well, let's kick off back here. And National Australia Bank Chief Andrew Thorburn is under police scrutiny over a luxury Fiji holiday arranged by a firm accused of bribing his former Chief of Staff to win contracts with the bank. The Sydney Morning Herald reports Mr Thorburn's former Chief of Staff, Rosemary Rogers, sourced the trip from executive events group firm Human Group. Rooms at the Fiji resort visited by the NAB chief cost between $6,000 and $45,000 a night. Detectives are now investigating whether Mr Thorburn reimbursed the Human Group and the circumstances of the firm's decision to pay for his holiday. NAB says there has been a number of, quote, inadvertent, unquote, breaches of company policy, but Mr Thorburn had been cleared of wrongdoing by the bank's board. Meanwhile, Mr Thorburn has had a third of his pay cut after the lender's full-year cash earnings fell 14.2% and the bank owned up to poor customer treatment. Well, for more on that story, Your Money Chief Business Reporter Leo Shanahan joins me live at the desk. Leo, I mean, that was quite a splash over the front page of the Sydney Morning Herald this morning. I mean, it sort of implied maybe that Andrew Thorburn was up to no good, but that's not necessarily the case.
No, and police aren't investigating Andrew Thorburn over this as such, and he's not being accused of any wrongdoing. What he did do is take this trip, it appears, and this trip was provided and then invoiced back to the bank through the Human Group, who were obviously this group under criminal investigation, along with his former Chief of Staff, Rosemary Rogers.
Was this a personal holiday?
Well, it appears so. Yeah. But it's not entirely clear as it stands, and I've been trying to get a clear answer on whether this was a personal holiday or a business-related holiday. But he doesn't seem to, there doesn't seem to be an issue of him taking something inappropriately or illegally. The issue is the invoice to the bank via the Human Group and their benefit from it, and the connection between his former Chief of Staff, Rosemary Rogers, and this group.
So this is digging into the original sort of allegations back.
So this is central to this type of payment is central to the broader criminal investigation into the Human Group and Rosemary Rogers' relationship with them. Is that the money they received via the bank and things they provided to the bank and how that was done, and did she benefit from that? Ultimately, what is being investigated here is
the story got out.
Yeah, it is interesting the story got out, and look. I don't like to question where other journalists get their stories from. It certainly gives me the pip when people do it to me. But I understand that police are of the opinion there is a concerted effort within NAB to destabilise Thorburns' leadership. And at this stage, that's where they seem to think the stories come from. Who knows? But it hasn't been a great day for Andrew Thorburn because he's also had to take a pay cut.
Well, that's right. I mean, we thought we might catch up with Mike Baird down at the ASFA conference, but I think he decided
conspicuously unavailable.
Better not a good day. Yeah. But yes, he's taken a pay cut. I mean, as have many of the other big bank CEOs. But this was directly, or it sounds like it's directly, in relation to the shrunken performance. Yes.
So his take home now is about 6.2 million. Reduced by about 2.1 from 2018. Now dropped to 6.2. Sorry, yeah, reduced by about $2 million. Total remuneration award in 2018 dropped by 2.1. But total bonus at the bank overall, and this is interesting, was drop was 114 million.
Okay.
So it's such an insight into the executive bonuses that we have going on there.
Briefly, I look forward to the Royal Commission.
Yeah, look, CBA first off the rank, first cab off the rank on Monday. They'll be followed by Westpac, Macquarie Group and ASIC. So one assumes in CBA you've got big hitters Matt Common and Catherine Livingston, followed by Westpac and Brian Hunter.
Right, and you'll be on that all next week, if I know you. Thank you, Leo Shanahan. Right, now the Sohn Hearts and Minds conference was held in Melbourne today. In attendance, some of the world's best fund managers and moneymakers. Well, Your Money business editor, James Daggar-Nickson, was actually at the conference today and joins me live on the ground. James, you've had a big day of it. What were some of the highlights?
Good question. I think Scott Bessent, which I know we're going to hear from a little bit later, but a fascinating keynote delivered by him, talking about sort of the three main issues that he sees out in the world at the moment, and understandably, a lot of focus when looking at a macro on the US economy as well as the US and China relationship. But he has some serious concerns about Europe as well, and fair to say he has some form in that part of the world, of course. Very famous when he was working for Mr. Soros in terms of betting against the Bank of England. So that was a major theme. The other interesting theme as well was, and look, you'd probably expect it, the vast majority, in fact, all of the people attending here that gave investment ideas, of course, stock pickers by nature. So there was a view that in the absence of QE, as we enter into quantitative tightening, as we see the Fed increasing interest rates, as we see this level of volatility, and I suppose the lack of artificial increases for asset classes, that stock pickers, bottom-up value stock pickers are going to be very much coming back into vogue. This is their time to shine. No pressure, of course, on them, but there is a feeling that, well, it's their time again.
Yeah, well, look, I remember last year. You remember Jeff Wilson picked Virgin and Virgin Australia, and that was a tricky one. And there are all sorts of reasons why it didn't come good the way he'd thought. But are there any other big calls that have been made this year?
Yeah, an interesting one from Thorney Group's Alex Weislitz. Austin Engineering, actually, it is a mining services company that essentially it provides, you know, the big scooper things that go on the front of trucks and tractors. They provide those, essentially. And there has been this belief that, as you've seen commodity prices do well, the miners are able to get costs down. There's huge levels of cash flow and the expectation of increased capex. Well, it hasn't come yet. Austin Engineering sort of been languishing. He thinks that that level of capex is going to come to bear, and there's going to be a big kickoff in the likes of Austin Engineering. That was one for him. You mentioned Jeff Wilson. He hasn't done quite so well with Virgin. He still has a strong belief, though, that he'll go private, so he'll win out in the end. He's tipping, I apologise, I can't remember the name of it, but it's a Japanese gaming company. Not something I'd expect Jeff Wilson to be all over, but he is at the moment. He thinks gaming is poised to continue the exponential growth, and this is an underpriced Japanese leverage play on that gaming space. Was an interesting one from him as well. And just finally, Peter Cooper as well. He was the last speaker to date, famously from Cooper Investors. He's tipping, believe it or not, a media company, Liberty Media, over in the US. There are three tracking stocks that match the three main assets. The one he really likes is Sirius XFM. He thinks it's a belter, satellite radio over in the US. So that's one of the big stock tips for this year's conference.
Righto. Well, Daggar, thank you so much for all your coverage right throughout the day on the channel. That was great. And would you like to throw to your big interview that you got today?
Why not, actually? It was an absolute pleasure to firstly hear his keynote this morning to kick everything off, and then to sit down and speak to Scott Bessent, formerly of Soros, and now his own gig, $5 billion funds under management at Key Square Capital.
We think you're at the cusp, and we're not sure which way the forks are going to go on three big trends. So U.S.-China relationship, my sense is it's going to be a separation, not a divorce. But it could get nasty, but that's not our base case. In Europe, the Italians and are they going to be able to bust open the European piggy bank, or are they going to bring the Euro project down with them? And then the U.S., will we continue to diverge because the U.S. monetary and fiscal policy is just so much ahead of the rest of the world?
I want to talk about that in a minute, what you've termed the great divergence. Before we get to that, and I don't mean to embarrass you at all, but the world of macro fund investing, a big, very complex one, and I've heard you described as royalty within it. So explain how you see the world, how you see markets, and how you then view potential opportunities within that.
Yeah, we try to keep things very simple. Right? It is, I actually don't have a Bloomberg, which the former mayor doesn't like for me to say, so sorry, Mr. Mayor. And we only need 3 or 5 big ideas a year. So for me, I have a really smart team of the young and hungry analysts. And my job is to coach them on, yes, this is a big idea. Let's get on a plane and go to Turkey and see. We spend a lot of time on the ground in places. Whether it was the Bank of England trade, the Bank of Japan trade, we were on the ground and had a lot of insight.
Well, I wanted to get your thoughts on that and how you see your personal investment strategy, because reading about you, and everyone is well aware of in particular the Bank of England trade, but patience and betting big, they were two recurring themes that kept coming up when reading people's and peers' views on you. How do you view what you do? How do you view what sets you apart, if you like, from the rest of the investment world?
Again, 70% of what we do is getting ready to trade.
Yeah.
We very rarely all the stars are aligned right here, right now. The Bank of Japan trade, they actually started 15 months before, with the Fukushima tragedy. So earthquake, tidal wave, near nuclear meltdown, and which caused the Japanese current account to go from plus 3% to a negative 3% deficit. So I've been thinking about shorting the yen for almost 15 months. And then one of our consultants in Tokyo called and said, there's this guy named Abe. He has a program called Abenomics, and he wants to take Japan out of reflation. You should get over here. So, so a lot of it can be very long runway.
Do you ever have moments of self-doubt, particularly, the size of the calls and quite often the contrarian nature of the calls?
Every minute. If you're not doing that, and is Mark Nelson asked me about the privilege of working with Mr. Soros and Stan Druckenmiller. What they are really good at is changing their mind and admitting you're wrong.
Do you think there's not enough of that?
Sure. It is you think about, why did Bear Stearns go down? Why did Lehman Brothers go down? They didn't have to. Right? It is, why did the U.S. housing crisis happen? No one wanted to raise their hand and be the one to call all sides.
Can we talk about what's happening at the moment? You sort of touched on it before as one of the key themes that you gave as far as the keynote, and that is, as mentioned, the great divergence between the US and seemingly just about everybody else. Just explain what's occurring and what the potential implications are from your perspective.
Sure. So the US, we are very good at two things in the US. One is causing problems from the world, but the second is lancing the boil very quickly. So we cut the losses and move on. So I think the U.S., as opposed to especially the Eurozone, after the GFC, the banks were recapitalized, assets written down, the central bank went to non-standard monetary policy way before everyone else. The Fed really sprung into action. In a way, we were fortunate that for the crisis period, I'm not sure about the post-crisis period, but for the crisis period, we really had a dream team in Paulson, Bernanke, and Geithner, right? So the U.S. has been on this growth trajectory. The Fed wanted to be behind the curve. They've gotten behind the curve. Then we had this surprising Trump victory in November of 16, and he comes forward with a $1.5 trillion with a T tax cut to stimulate the economy. And then that was in December of 2017. In the beginning of this year, the Republicans and the Democrats finally found something they could agree on, and they took off spending caps of $3 billion over 2 years. So we've added between 1.25% to an economy that was already growing, already at full employment. So the U.S. is just hoovering in money. Is very smart investor here asked me the other day, said, well, what are you thinking about equities? And I said, well, I think it's going to be a little rockier now. And he said, well, couldn't you have said that 2 years ago? And I said, difference is 2 years ago, the U.S. 2-year was at 1%. Yeah. Now you can get 3% risk-free for 2 years. That's a competitive rate, right? And it seems like most pension plans, benchmarks, endowments have about a 7% hurdle, or annual return target. So you can get 40% of your annual return target with a 2-year U.S. Treasury. Why? Why go to Argentina? Why put up with nonsense in Turkey?
After the break, another exciting interview. The top economic advisor to Bernie Sanders' 26 election campaign, the controversial Stephanie Kelton, next.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. Well, she was Bernie Sanders' top economic advisor when he ran for the White House, and she's also said to have had the biggest idea in Washington in recent times. The idea that the US government can't run out of money or go bankrupt no matter how much it spends and borrows. Stephanie Kelton is her name. She's still a very influential economist in the US, and she's currently pushing the idea of a national jobs guarantee. Activist group Get Up have brought her out to Australia this week for a series of talks which are bound to be provocative. I know plenty of people interested in going along to hear the economic arguments of the populist left. I put my tin hat on and really enjoyed our interview a short time ago. Stephanie Kelton, it's great to have you in the country.
Thank you.
Now, look, I feel I'm going to have to somehow defend capitalism at the moment. So we'll have a great conversation, I'm sure. What is your pitch? What is your message out here?
Well, so Get Up brought me,
Yeah.
and I'm here with a couple of other people who worked on the Bernie Sanders presidential campaign.
Right.
And so I guess the pitch is that, you know, we can do big, ambitious things. And so one of the things we're going to talk about is a policy idea that's become very popular in the U.S., and I know there's some interest in it here as well, and that's the idea of a federal job guarantee.
Yeah. To do that, your theory behind it is, I mean, you really turn the whole idea of budget responsibility, as many governments around the world think it, on its head, don't you?
Yeah, well, exactly. In fact, I think we would redefine what it means to exercise a responsible use of the budget. And so allowing 700,000 Australians who want work and can't find it to remain unemployed in the economy is maybe not a very responsible way to use the federal budget. Maybe it would in fact be more responsible to use the budget to put those people to work and to improve, you know, lots of things about the economy, have more output, have more public goods, have people who, you know, are desperate to contribute in some way, find a way to be able to do that.
Now, of course, that's incredibly hard to argue against, given the great purpose, but it's going to cost money. And that might be at the expense of a surplus, which in Australia at the moment is tantalisingly close.
So, you know, I look at the budget very differently. I say, you know, the goal is not to put the budget in a nice place and to make the budget feel good and warm and fuzzy. The goal of using the federal budget is to balance conditions in the broader economy. You don't force your economy to balance your budget. You allow the budget to balance broad conditions in the economy.
So a national economy is not like a household.
Well, that's a very good place to start, and I think that a lot of the times that's the biggest mistake that we make, is thinking of the federal government as a giant household and thinking that what's good for us, spending less than we take in, saving some money, paying down debt, that this is very judicious at the individual level. It makes sense for people like you and I to behave this way. But if we extend that thinking to the federal government and we say, well, if it's good for us, it must be good for the federal government as well, then you can get into all kinds of trouble and bad economic policy.
Okay, so a lot of people would turn around and say, well, speaking of bad economic policy, where is the responsibility? Because if you take this to the logical conclusion that, let's just say, what we'd like as an objective as a society. Well, we'd like everybody to have a job, we'd like free education for everybody, we'd like free health for everybody, we want all these great things, we want to live in this nirvana, and actually we don't care how much we end up borrowing to deliver that. How long do you think a country could sustain itself like that?
So the limits are very real. It isn't the case that the government can just go around spending willy-nilly, putting more and more resources into various programs because it would make us feel better to have people with, you know, more expensive cars in the garage and more spending on education and everything else. The limits are, look, if you've got room in your economy to do more, whether it's in healthcare or education or infrastructure or whatever the case is, then can you use the government's budget to put people to work, to improve lives of people?
Even if that meant deficit upon deficit upon deficit?
Sure. For most of Australia's history, you've had budget deficits. It's also the case in the U.S. For most of our history, we have run budget deficits.
So this is a Keynesian argument, and indeed, look at what Ben Bernanke did after the financial crisis. You know, we have now, we now threw money at this problem in order to get ourselves out of the crisis, or printed money rather, to get ourselves out of this crisis. It has, however, left the entire world much more vulnerable to the next crisis, hasn't it?
In what way?
Well, there's not the padding in terms of rates or in terms of money in the central bank to be able to help the next time there is a crisis.
Well, the central bank can always do more, right? Because the central bank doesn't have any kind of constraint whatsoever. There's really no limit on what the central bank can do in terms of purchases. It is the ultimate place to backstop any downfall in the economy, if you like.
But surely that's got to stop somewhere. I mean, what is the difference between that thinking and what happens in a South American country, in that inevitably what happens is that you lose confidence from overseas investment, you get dramatic inflation, the value of your money that you're spending as a people goes down, and the whole place goes to hell in a handbasket.
So what's happened in many Latin American countries is very different. Normally they have a monetary arrangement that's built around a fixed exchange rate system. You don't have that, we don't have that in the US. You have political crises, you have problems on the supply side of the economy, you have crop failures, you have something that disrupts fundamentally the economy and leaves them with too little supply. And this is really where you get into the problem of kind of heightened inflation, is that you have something bad happen on the supply side of the economy.
But what you're saying is it doesn't matter how much debt or how much money you print as the central bank in the US or indeed anywhere else in the world, that's okay. At the end of the day, it doesn't matter if you've got debt which you build up to deliver, you know, paying out debt, actually, or paying the interest, starts becoming more than what you're earning in as a country, and you inevitably get into this spiral. You end up like Greece. That's okay for a major superpower.
So Greece ended up like Greece because Greece started borrowing in a currency that they no longer controlled. So when Greece had a debt ratio of about 140% relative to their GDP, but it was all denominated in the drachma, you didn't have a debt crisis in Greece. It was only after Greece began borrowing in a currency that they could no longer create that Greece suddenly found itself in a situation where it's got payments coming due and it literally cannot come up.
But even if you're doing this within the US dollar, I mean, surely the sort of the 11-year-old boy test is, hang on, there's something that's not working here. You can't just continue to borrow in your own currency and just print money and that's going to be okay.
But we have. We've done it our entire history. So
and it's a problem. And there's a lot of people saying it's a problem.
Well, it's not a problem in the United States. In what way would it be a problem? So if you said, look at the United States, right? The national debt is $21 trillion.
Yes.
Okay, where is the problem?
Yeah, well, it's got to be, at the end of the day, somebody is lending that money, no?
No, actually, what the government has done is when it runs a budget deficit, right, it spends more than it collects in tax. Let's say it spends 100 into the U.S. economy, but it only taxes 90 back out. It's leaving behind 10. They'll call it 10 US dollars. So government deficits are surpluses to the rest of the economy. And this is something I think that's really important that people tend to forget because they go through life kind of with one eye open and they say the government's budget is in deficit. This is a terrible thing, but hang on. Look at it from the other perspective, right? The government's deficit is supplying financial assets, dollars, to the rest of the economy. Now the government goes in and borrows. So you say when the government runs a deficit, they borrow, and that adds to the debt. But they've already supplied the money to buy the bonds. So now they say, I run a deficit of 10, I'm going to auction bonds.
But it's a bit like a pyramid selling situation.
Well, it's not. No, in a pyramid scheme, you've always got to find money to finance the next guy, right? And with the federal government, you're the issuer of the U.S. dollar. Where else would it come from? Yeah, the U.S. dollar. I mean, literally, it can't come from anywhere else. It doesn't come from China. It doesn't come from me. I'm a household. I don't supply the U.S. dollar.
How do you see that the Bernie Sanders policies are different from the Trump policies? Both are populist, one's from the left, one's from the right. How do you see them being different? Because, of course, we've got almost record unemployment now, haven't we?
Record low, near record low. Exactly. Yeah. So I think that it's really interesting, and you're exactly right, that both of them speak to the same sorts of anxieties. When Donald Trump ran for president, you might remember he went out there and he said to people, we're going to make America great again. Help is on the way. Help is on the way was his message. Whereas Hillary Clinton, who ran against him, her message was America is already great. And, you know, people heard him speaking to some anxieties and some pains that they didn't hear her speaking to. And that message resonated with a lot of people. There is a lot of economic anxiety in across much of the U.S. And Donald Trump's way of speaking to that was to say, I'm going to protect you. There are things that are hurting you, and I'm going to protect you from those things. For him, that means protecting you at the border. It means protecting you from immigrants. It means protecting you from bad trade deals. There's a protectionist layer to that rhetoric. Senator Sanders speaks to the same kinds of economic anxieties. He talks about inequality, he talks about stagnant wages, he talks about unemployment and underemployment, and he says, I want to protect you from these things too. I want a $15 an hour minimum wage. I want to protect you from the rising cost of education and health care.
So it was really interesting. We had Neil Ferguson, the economic historian, come through the other day, and he said he was observing how almost across the world, and Bolsonaro in Brazil being the latest, we've had populist right and populist left, but it's been the populist right that have succeeded in getting into power. And his explanation for this was that whereas the sort of Sanders approach and indeed the Corbyn approach in Britain is very much driven by, you know, the one message about inequality, whereas the right have a lot more sort of colourful and a lot more, I suppose, complex message, which is more about, as he was saying here, bash Mexico, bash China, rather than just blame the bankers. You know, make America great again, build the wall, lock her up. It's and you know, the whole issue around trade, rather than just the single us and them message.
So I think that's a little bit unfair, because Senator Sanders was fairly aligned with Donald Trump when it comes to trade. I mean, this is an individual who said a lot about bad trade deals and what NAFTA has done and the hollowing out of many communities in America, the Rust Belt and so forth, the loss of manufacturing jobs. So when it comes to
you
trade,
yourself, I think, argue that exports, you know, exports from a country like America cost the home more than if you were just producing for yourself, do you not?
So I look at exports. I mean, the idea for me is that if you're working and producing things at home, but you're shipping them off abroad for someone else to enjoy, to consume, and to raise the standard of living of someone else, maybe there's another way of thinking about the benefits of trade. That what Donald Trump does is he looks at the U.S. trade deficit and he says, they're killing us, the rest of the world is killing us, because he says, look at the cash flows. So he sees a trade deficit merely in financial terms, and he says, we're getting killed.
But even from your point of view, what if the public actually want product from another country?
Right.
And what if the cost of producing it all yourself in your country, because of the high labour costs that you'll be giving everybody higher wages, it becomes uneconomic for you to do that as compared to entering into trade agreements?
Yeah, so there are benefits to having other countries willing to be a low-cost producer for the U.S., allowing U.S. consumers to import cheaper goods at home. The challenge is when you allow the foreign production to displace American jobs. That's the challenge. And so the question is, are there policies that you can put in place, like a federal job guarantee, so that you can keep employment at full employment domestically, but still enjoy some of the benefits of being able to consume what the rest of the world is producing?
Boy, I'd love to have a long glass of wine over dinner with you. It would be great to have a long chat. Stephanie Kelton, I hope you enjoy your trip here. Thanks.
Thank you so much.
Now, after the break, more problems for the British Prime Minister Theresa May. We'll get the latest on Brexit with the Australian British Chamber of Commerce CEO David McCready next.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Well, British and Northern Ireland Prime Minister Theresa May has vowed to see her Brexit plan through, despite facing a possible vote of no confidence after a series of ministerial resignations over the draft Brexit deal. Mrs May has also suffered a bruising session in the House of Commons, with MPs on both sides saying they couldn't support her plan. Well, joining me for more Brexit implications, David McCready. He's CEO of the Australia-British Chamber of Commerce. David, we've got you back in.
Thank you to see you. It's great to see you.
Yeah. Well, between the time I last saw you, Theresa May's had quite a time for it. That parliamentary question time, Prime Minister question time yesterday.
Yeah, it was hard going.
Ah.
But I think the interesting thing is, we only spoke on Monday.
Yes.
And since then, we talked about would there be a deal or not.
Yes.
Cabinet's approved it.
Yeah, it is amazing, isn't it? Yeah.
And she's still chugging along.
Cabinet has approved it. And I should add that we don't have anything like this in Australia. This is Prime Minister's question time. So she just gets barraged, question after question after question. And she did. She did a pretty good job, considering, didn't she?
She did a great job, actually. I was very impressed. And I think the other thing to keep in mind, I watched a lot of it last night, about an hour and a bit. And by that stage, I think it was ready for bed.
Yeah.
But she did did a great job in terms of pointing people back to the agreement, saying actually that's not true. And a lot of the questions were really based on people who probably hadn't read the agreement in full. There were certainly some who had, or certainly their advisors had, and had given them the tips on which sections to note. But she did a great job. And the other thing to really note, particularly compared to our own parliament, was the number of people on both sides who congratulated her for being completely honest and hard-working on this, as she could be, persevering with it through all sorts of strains to get it to this point. But then also saying, I'm not going to support it.
Exactly. I mean, and this is the big challenge, because they've got to get it through Parliament. We've got the European Council, they've got to be passed in Europe, but you'd think that that would be not too bad. But they've got to get it through Parliament. Now, at the moment, Jacob Rees-Mogg, who is basically, he's the lead Brexiteer, isn't he, effectively, the group?
Yeah, so the European Research Group, which he leads, which is about 50 or so Conservative MPs.
So he's written to something called the 1922 Committee, which is the group of Tory backbenchers, a vote of no confidence in the Prime Minister. Now, how could that develop? So
they need 48 letters to the chair of the 1922 Committee. He made it very clear in the House last night that he wanted an answer on the issues that he raised in his question. Otherwise, he said, I will write, and he subsequently said that he will. So
didn't get the answers?
No, he didn't. not the ones that he thought he wanted.
Yeah.
But there are only about 15, and forgive me, I've been doing other things today. I haven't seen any more that have come out in the wee hours of the UK overnight.
But say they get that 48, then what's got to happen?
So then there's a potential leadership spill within the Tory party.
And she needs a simple majority.
Well,
they need a simple majority to knock her off.
They need to get more than 159 of the Conservative members of Parliament to vote to remove her.
Yeah.
And if they don't get it, if they try and they don't get it, they have to wait a year.
Yes.
Before they can try again.
Yeah, so it's a big roll of the dice, isn't it?
It's a massive roll of the dice, and I think for that reason, regardless of the numbers being at close to 48 potentially, if all of Jacob Rees-Mogg's acolytes sign up, I think they'll make sure that they have the numbers for that rolling before they make sure the last letter goes in. So
basically, we need to have an alternative Prime Minister that would work. Now, is Mr Raab, the Brexit Secretary who resigned, an alternative Prime Minister?
Possibly. At this stage, there aren't any front-runners.
Yes.
Remarkably, the former Foreign Secretary, Boris Johnson, has been remarkably quiet by his standards.
Yeah. Liam Fox has been quiet?
Liam Fox has been quiet, although I'm not sure that he's still in the Prime Minister's camp at this stage, so I don't think that he would be necessarily a front-runner.
Yes.
Jacob Rees-Mogg has obviously made himself a name in recent times, but he made it clear last night that he didn't have ambition for the leadership. So,
but point I'd make is that back in 1990, I think Thatcher actually remained. She got she remained when the 1922 committee voted against it. But she didn't. The vote went in a weird way, and she was affected by it.
Yeah, so she managed to keep the numbers, but she was wounded. It's no different than what happened here in Australia with Malcolm Turnbull before, with the first vote with Dutton, and then obviously something different happened at the end of that week, and we wound up with a third candidate, which wasn't a contestant on the Monday.
So they've got to move soon if they're going to do this, haven't they? Because if they change leaders, it's going to take weeks, and presumably Article 50, everything will be delayed.
Well, the problem essentially is that, somewhat like the Labor Party have here in Australia, there's an element of the Tory leadership which is consulting with the grassroots of the party. So that could potentially, I understand, take as much as 2 months, and given it's over Christmas, maybe that's even worse. So it's not an ideal time to try and roll the leader. All right, well, what a mess. Thank you for bringing us right up to date, David McCready. It's great to talk. Thanks a lot. Have a good weekend. OK, moving to our markets now. The ASX 200 index closed down 0.09% on the day, down 3% though for the week. Australian shares plummeted after a risk-off market sent it into a nosedive on Tuesday and Wednesday, wiping $54 billion from the boards in the past 5 sessions. For a wrap of the markets for the week, I spoke with Michael McCarthy from CMC Markets.
Michael McCarthy, the end of another busy week, and you've got to hand it to the AFR for this news about Myer sales. Joe Aston got a hold of the Myer sales, and we're now in a trading halt.
Yeah, Ticky, I'm not a lawyer, but I have had a lot of compliance trading, and one of the key offences under the Insider Trading Act is passing information that's not publicly available to people who have can reasonably assume will act on it. I wonder if that captures journalists, because this is definitely not public information, and I think it's a bit embarrassing for Myer.
Very embarrassing for Myer, but it obviously would move the market, which is why the ASX has put the pressure on them to...
Well, absolutely. They're in suspense until Monday, until they can come up with a response to this. So I don't see this as a positive development in the health of the Australian stock market. I don't think this is a good idea. And taking this to its logical, absurd extreme, people calling for Myer to report quarterly, well, how often should they report? Should they report sales weekly, daily, hourly?
Yes.
The reality is there's a balance to be struck here.
This was a scoop, but, I mean, given the information that has come out about the sales, it doesn't look very good for Myer, does it?
No, it doesn't. If those numbers are correct, and we don't know that yet, but if they are correct, it's bad news. But it should be expected. The new CEO is trying to turn this business around. They're trying things. Now, at least he's been honest enough to say we don't have all the answers, but we're willing to experiment, we're willing to give it a try. And I think shareholders who've stuck with Myer through the very thin times we've seen over the last few years are probably willing to give the new CEO a chance.
I spoke to Anton Tagliaferro, who's a major investor, the other day, and he seemed to be of that view. But I wonder what he'd think of, given that everybody's talking about these really weak retail numbers going into, more broadly, going into Christmas, how we think Myer's going to go when it comes out the other side.
Well, it still looks like a binary outcome. And one thing I think we can say for sure here is that Myer's business will be transformed. But the key question is, will it be transformed by Myer itself or by outside parties?
These sales numbers include the online sales numbers, which are going backwards from last year. Again, if true, that surely is slightly worrying.
Absolutely. And I think they're coming up against a model that seems to be getting more and more appeal. What I'm seeing online these days is that shopping centres are offering online shopping for all the shops in their group. And that, of course, is a much bigger offering than any department store can offer. And so we know they've got competition in the bricks and mortar space, and now that seems to be spreading to online as well.
OK. Look, lots of news around BGH, Ben Gray's private equity outfit. He seems to have be sort of in battles on two fronts now. Firstly, for Healthscope, we had that surprise of the Canadians coming over the hill with a much improved bid, you'd think.
Well, what looks like a knockout bid to me. I mean, it's 1.5 cents shy of the 12-month high.
And the board's given them access to the so the White Knight.
Exclusive access too. So that really locks BGH out, and it creates an interesting situation for Australian Super, who've committed to the BGH bid until March next year. But
that's where the scheme of arrangement was. So part of this, was it $2.85 or I can't remember the number.
$2.45 or $2.58.5.
Right. OK, but includes partly a scheme of arrangement. Now that kicks off literally, I think, the day after that exclusivity agreement ends, and there's an opportunity for Aussie Super to be part of the private equity bid as well, or at least have a holding in the business going forward. So I think it's quite an interesting White Knight proposal. Then we've got Navitas, which is the other company that BGH was going into again. And look, it's a really interesting idea, teaming up with Super, which presumably wants to get into some of the private business as well as public. But again, there was fisticuffs, and the board doesn't like it. The founder seems to be on the side of BGH and Aussie Super.
Well, which begs the question, why do they need due diligence if they've got a former chief executive officer on their team? But look, I think that's good practice, and I'd applaud the chair here, because the reality is the private equity bids we've seen over the last 5 years are almost obnoxious in their lack of commitment on the part of the bidder. They're so conditional, the bidder can walk away at any time, and we've seen share prices hurt where management have allowed a team to come in and do due diligence, they then walk away without making a bid. Well, clearly shareholders are going to interpret that as a negative, as does the broader market.
After the break, talking venture capital and fintech with Daniel Darling of Darling Ventures and Ryan Welsh, founder of Kindy. Next.
Now, back to Ticky.
Welcome back. Well, we often look at how Australia is working to attract venture capital money into Australia, particularly for some of our up-and-coming fintech stocks. Well, apparently there's a reasonable amount of money going the other way too. Daniel Darling is an Australian investor based in Silicon Valley, in San Francisco actually, where he's the managing director of Darling Ventures. He's busy building a portfolio of investments in the US startup community, and he was over with one of those businesses, Kindy, founded by Ryan Welsh. I caught up with them both earlier in the week at the UBS Australasia conference. Daniel Darling, I'll start with you. What sort of a business is Darling Ventures?
Thanks, Ticky. Well, I've been over in California for the last 8 years working in technology, and the last 4 has been with Darling Ventures, which is an early stage venture capital firm that I started to really bridge Australian capital into really interesting deep technology and data-centric US technology startups. So I am their man on the ground to help find early stage opportunities for them to invest in.
And when did you come across Kindy?
Kindy would have been about 3 years ago. Yeah, we were us and another Silicon Valley firm were the first check into Kindy at the seed stage when they'd spent about 10 plus years in academia developing out the core research.
So what attracted you to Kindy?
So we have a big interest in enterprise AI, and particularly those that have differentiated themselves in driving business value early. And we think that Kindy's way to prove value in an enterprise in a very short period of time has a unique advantage, and we think that its ability to be explainable in its results and answers as opposed to the rest of the market. Well,
Ryan, that's where you come in. Explain to me what Kindy's business model is, because it's involved with the AI space, part of AI, but it's a special part of it around machine learning, isn't it?
Yeah, well, there's actually 2 aspects of AI. There's machine learning, and then there's what's called knowledge representation and reasoning, and a lot of folks forget about that aspect of artificial intelligence. So we actually fuse those 2 paradigms together, which make the system explainable.
I often think that all this machine learning, this has been thrown around as a phrase. It's a bit like the old greenwashing. It's sort of AI washing. I'm not quite sure whether these companies are any good or not. What is it that your products actually do to look at the value of machine learning?
So it's a platform that leverages unstructured internal text data for organizations. So anything that you want to do with that, search, discovery, analysis of natural language data that people generate on an everyday basis. Emails, memos, all types of things that enterprises have. So for our pharmaceutical customers, we can help them find new and novel ways to leverage existing inventions that they have internally by looking at their internal unstructured text data and finding things that they would have not have looked at previously.
So Ryan, do you actually write the algorithms that are part of this machine learning and then you audit it, or do you actually audit other machine learning?
Yeah, so our system is auditable from the beginning in how we built the system. So we have proprietary algorithms that when it learns from the data, then represents the data model in a way that is explainable to users. So typically, that data model that gets learned is this giant black box network of connections of nodes and other things that the average user can't understand. And, it really takes a data scientist to understand. But for us, that network is natural language. And when we unpack, or ultimately bring back results, we can explain our results and our reasoning to the everyday user in natural language.
So Daniel, when you looked at Kindy, I mean, what stage did you come in, and where are you taking Kindy and Ryan?
Yeah, so we like to come in at the very early stage. So we were probably the first institutional check-in with another firm, Pivot North Capital. And we look to incubate companies throughout this increasingly large seed stage. Companies are taking more and more capital in at that time. It's taking more and more time to take very sophisticated research and bring it into product and then bring it into revenue producing business.
So interestingly, you're an Aussie, but taking Aussie money into the US market. There's a demand for that.
Yeah, we think that, you know, if you're going to go fishing, fish where the fish are, and the US has been the dominant #1 market for startup technology, and we want to be the avenue for Australians who are interested in technology investing into that market, which isn't always easy. So we found that as the Australian interest domestically for investing in technology and innovation grows, as does the sophistication of understanding what companies are offshore and the interest in the market of the US.
What other spaces are you looking at on the US side?
So we love data-centric companies, we love deep tech, which is kind of this new innovation of, that includes everything from cybersecurity to what we call Industry 4.0, which is areas like digital twin and bringing manufacturing online and basically creating a whole virtualized simulated model.
And that's all for the show tonight. See you on Monday at 5 p.m. on free-to-air Channel 95, or tonight on Catch Up at 8 p.m. on Foxtel's Channel 604. Thanks for your company.